All right, welcome back, everybody. Talking with Dean Maki, Chief U.S. Economist at Barclays Capital. And as we mentioned, he's one of the top-ranked economists according to Bloomberg data. So, Dean, you talked about the weather factor, and you mentioned how it might relate to the labor report that we get on Friday. Does that mean we kind of should disregard these data points at this point?
I think if we do get a large negative print, as we're expecting, I do think you want to look past that. There are some indicators that are less subject to weather. We got a couple of those this week in the ISM surveys, and both on the manufacturing side and especially on the service side, we're seeing a pickup in activity relative to previous months, and that does suggest the underlying trend in the economy does remain healthy.
Does it also say that we're moving from a factory-led, manufacturing-led recovery to the rest of the economy, which, as we know, is a much bigger part of the overall economy?
We certainly are seeing a spreading out of that kind of rapid pace of growth into the service sector. This is the first month we've broken well above the 50 mark on that ISM non-manufacturing survey, a very good signal that activity is improving dramatically.
I mean, is it just optimism at this point, or do you see actual signs that show us that we're moving to a service recovery as well? Because that's really key, isn't it, for a sustained economic recovery?
Well, we've certainly seen in the labor report itself, the service sector has shown a couple months of job growth now. So that's giving even a little better picture than the ISM was giving prior to today. So in a sense, the ISM is picking up, I should say, to where the payroll report already was telling us the service sector was.
When are we going to see continuous additions? I mean, when are we going to start adding 100,000, 200,000 jobs a month to the non-farm payrolls and not just see it as census jobs?
We think in the March report, we are going to see a significant improvement. So February goes down a lot on weather. March improves both because of census, also because of a snapback. And we think from there forward, we are generating jobs at a quite healthy pace.
You know, Dean, what I find interesting is that, again, people are starting to kind of talk about the prospects, or at least being asked about the prospects for a double-dip recovery. We stopped doing that, it seemed like a few weeks ago, but it's back. I mean, is that a real possibility in your view?
I don't think it's likely this year. We've just have too much stimulus, both on the monetary side as well on the fiscal side, as well as just the natural cyclical dynamics of the economy are pushing towards recovery at this point. So I don't think a double-dip recession is likely in 2010.
Not 2010. Are you saying that it could be a possibility in 2011?
Certainly, as you start looking further out, then you do have more of a possibility of shocks hitting the economy, pushing it into a downturn. Certainly not, by no means our baseline case. We think growth will continue through 2011, but I think the further out you look, the more likely it is that something happens.
What's your expectation for the Fed movement in this forecast? I mean, do you see the Fed on hold for the entire year?
No, we think the Fed is going to start raising rates later in the year. The Fed wants to see a number of months of declining unemployment before they're willing to raise rates. We think we will see that, and later in the year, the Fed starts to edge up that funds rate.
And then also continues its plans to unwind all of that quantitative easing as well?
Certainly the Fed's going to be reducing excess reserves. So that's going to actually start happening even before they hike the funds rate, in our view. So around mid-year, we think the Fed is beginning the technical process of reducing excess reserves.
Let me quickly ask Dean your view on the housing market here, because it seemed like things were leveling off and getting better, but we've had some really awful data points over the last 2 or 3 weeks here. Does the housing market actually pick up and stabilize out this year, do you think, or do we see continued problems there?
We do think that the housing market will pick up as we move through the year. We have started to bottom out on a number of indicators. It's still not extremely healthy growth by any means. The tax credit has thrown a lot of volatility into the data, but we do think housing is going to be picking up as the year proceeds.
So, Dean, what is the big risk at this point? I mean, the equity markets, the financial markets have been watching very closely all the developments outside the U.S., particularly what's going on with Greece. But is that the big risk, the sovereign debt positions, or what do you see as the big risk here?
To me, the biggest risk right now is on the commodity price front. We do think that the global economy is recovering robustly. That does mean commodity and energy prices should be moving higher. If that were to get out of control on the upside, that would form some risk to the recovery.
All right, hey, Dean, thanks so much for joining us. Dean Maki there from Barclays Capital.